Hello friends. In the last lecture we were discussing about revaluation of assets and liabilities, right? That we have to revalue them. Why? Because any profit and loss arising on the revaluation of assets and liabilities before the date of change in profit sharing ratio, it should be distributed among partners in old ratio, right? For that purpose I discussed about the revaluation account that we will be preparing. Now let's see a practical problem on this. Read the practical problem. X, Y and Z are partners in a firm sharing profits and losses in the ratio of 3:3:2. Their balance sheet as at 31st March 2016 was cash at bank, sundry debtors, stock, machinery, building, advertisement expenditure, that is a deferred revenue expenditure. Remember? Accumulated losses. Then on the liability side we have sundry creditors, journal reserve and capital accounts of X, Y and Z. Now further it reads, the partners decided that with effect from 1st of April 2016 they would share profits in the ratio of 4:3:2. It was agreed that stock is to be valued at 1,10,000. What is the original value given in the balance sheet? 1,20,000. So that means we have to reduce our asset by 10,000. Machinery is to be depreciated by 10%. Another asset to be reduced by 10%. A provision for doubtful debts is to be made on debtors at the rate of 5%. Another asset to be reduced by 5%. Building to be appreciated by 20%. Finally some asset is being appreciated, right? A liability for rupees 3,000 included in the sundry creditors is not likely to arise. Another good news for us, right? So partners agreed that revised values of assets and liabilities are to be recorded in the books. They decided to retain journal reserve in the books, give necessary accounting entries. Now they decided to return journal reserve in the books. Recall the accounting treatment of reserves and accumulated profits and losses. The last topic in that if partners decide that the reserves and the accumulated losses will appear in the books at the old values. Now there are two things. One is general reserve and the other is advertisement expenditure. But they have decided to retain only the general reserve in the books. That means advertisement expenditure will be distributed among partners in old ratio, which will not be shown in the new balance sheet. Clear? Now let's first of all prepare the revaluation account for this purpose. We'll prepare the revaluation account. In case of revaluation, you should always prepare first the revaluation account, because with that your journal entries will become very easy, because all the calculations will be done in revaluation account. This is debit, credit. Remember, formats are very important in the examination. Do not forget the formats. Please prepare proper formats. Particulars, amount, particulars and amount. Clear? Now see. First of all, they say stock is to be valued at 1,10,000. So there is a fall in the value of an asset by 10,000. Where to be recorded? We'll say to stock. 10,000. Next, machinery is to be depreciated by 10%. What is the value of machinery? 1,59,000. So 15,900 will be machinery. $15,900. Next, they say a provision for doubtful debts is to be made at the rate of 5% on debtors. Now, what will be the provision at the rate of 5%? Debtors will reduce, I'll say, to provision for doubtful debts at the rate of 5%. It will be 2,500. Clear? What is next? Next, they say building is to be appreciated by 20%. Now building is 2 lakh. 20% of 2 lakh, 40,000. So we will say by building it is 40,000. Clear? Next, they say liability for 3,000 included in the sundry creditors is not likely to arise. This is again a good news for us. We'll say by sundry creditors 3,000. Clear? Now, which side is more, credit side or debit side? Clearly, the credit side is more than the debit side. That means we are having a gain on revaluation. To gain on revaluation. Now, this gain will be transferred to partners' capital accounts. So, X, Y, and Z. I'll say capital account, Y's capital account, and Z's capital account. Clear? What are the amounts? In old ratio, remember this. This total amount was 14,000. So this is your revaluation account. Clear? This is your revaluation account. Right? This is, we have distributed the gain on revaluation in old ratio. What is the old ratio? See the question. They say they are sharing profits and losses in the ratio of 3:3:2. Right? So in that ratio, we have distributed the gain on revaluation. Now you have to pass the journal entries regarding this. Very, very simple. First of all, let's calculate the share of sacrifice and the gaining share by partners. Calculation of sacrifice or gain. Right? How it is calculated? Old share minus new share. Let's see for X. If we talk of X, what is the old share? 3/8. What is the new share? 4/9. So this comes to 5/72 negative. That means X is the gaining partner. Right? Let's see for y. 3 by 8. Now it is 3 by 9. So it comes to 3 by 72. That means y is sacrificing some part of profit. Z share 2 by 8. New share 2 by 9. So this comes to 2 by 72. This is also sacrifice. So the accumulated amount of sacrifice is equal to accumulated amount of gain by partner X. Y and Z are the sacrificing partners. X is the gaining partner. Now let's pass the journal entries. First of all, we'll start with this revaluation account. First entry, building account debit, sundry creditors account debit to revaluation account. We'll say building account debit, sundry creditors account debit to revaluation account. Clear? What are the amounts? 40,000, 3,000 and 43,000 is total. Now let's see the other side. Other side is revaluation account debit to stock account, to machinery account and to provision for doubtful debts account. This will be revaluation account debit to stock account, to machinery account and then to provision for doubtful debts account. What is the amount? 10,000, 15,900 and 2,500. So the total comes to 28,400. Clear? There is one small mistake. This total was 14,600, not 14,000. Clear? Now, what is left is the gain on revaluation, that is to be distributed among partners. Third entry will be revaluation account debit to X capital account to Y's capital account and to Z's capital account. What is the total gain on revaluation? 14,600. And how the distribution is done? In the old ratio, that is 3:3:2. 5475, 5475 and 3650. This is the gain on the revaluation that we have transferred. Now if you see the question, there is advertisement expenditure, that is deferred revenue expenditure. This expenditure is to be transferred to the partners capital accounts in old ratio. So what will be the entry? X capital account debit, Y's capital account debit, Z's capital account debit to advertisement expenditure account. This is 4,000. So this will come to 1500, and 1000. This is the distribution of the deferred revenue expenditure. Now there is one last very important point which reads that the general reserve is to be retained in the books. General reserve of 36,000. Now recall, if the reserves are to be appearing in the new balance sheet at the old values, what were the steps? First of all, we will calculate the net effect. Here there is net effect of 36,000 only, because there are only general reserves, right? Then we have the share of gain, that is 5 by 72. Now it is a positive net effect. What will be the journal entry? Gaining partners capital account debit, X capital account debit. What will be the amount? Amount will be the amount of general reserve into share gained. Clear? This comes to 2500. To Y's capital account, to Z's capital account. What will be the Y's capital? Now this will be distributed in the ratio of 3:2. In the ratio of sacrifice, this will be 1500 and 1000. Clear? This is how we will retain the journal reserve in the books at the old values. You can show the whole steps in the working note if you wish to. If you have time in the examination, you can always show all the steps, right, clearly for the valuation of this, right? So this is how we'll be passing the journal entries. Easy. After the revaluation account, this becomes a very simple job, right? Now one more thing which is not asked in the question. If they ask you to prepare the new balance sheet of the firm with the revised values, if they ask you to prepare the new balance sheet of the firm with the revised values, how will you do that? For that purpose, first of all, you will have to prepare the partners' capital accounts, because we have adjusted the partners' capital accounts, right? I'll show you quickly what to do. Partners capital accounts you will be preparing, because we have made the adjustments through partners capital accounts. Let's see quickly how to do this. We have three partners, X, Y and Z. X, Y and Z. We are given the balance of capital. Balance brought down, we are given in the question as 2 lakh, 2 lakh and 1 lakh. We'll say 2 lakhs, 2 lakhs and 1 lakh. Now see the journal entries here. Buildings and greatest revaluation, no count. Revaluation to stock machinery, no count. Revaluation to X capital, to Y's capital, to Z's capital. The gain on revaluation will be credited to the partners' capital accounts. So here we will say revaluation gain we will have as 5475, 5475 and 3650. Next, we have advertisement expenditure. What to do with the advertisement expenditure? The partners' capital accounts have been debited. Here we'll say advertisement expenditure. How much it is? 1500 and 1000. Next, any other effect? Yes, X capital account has been debited and Y and Z capital account have been credited for journal reserve. X capital account will be debited with 2500 and Y and Z 1000. Anything else? No. So we'll calculate the balance of the capital accounts. The balances will come to as 2,01,475, 2,05,475, right, and 1,03,650. Clear? These are the balances of the capital account. Now if we have to prepare the balance sheet, we can easily prepare balance sheet at the new values. Let's see. You have to prepare this balance sheet only if asked in the question. No need to otherwise prepare it. Okay? You can be asked in the question to prepare the new balance sheet. First of all, we have cash. Cash we have 27,000. Then we have debtors. What is the amount of debtors? 50,000. 5% provision. Right? This comes to 47,500. Next, stock. It is given to be valued at 1,10,000. Then machinery to be depreciated by 10%. The value comes to 1,43,100. Then building to be appreciated by 20%. 20% of 2 lakh. The value comes to 2,40,000. Here, creditors. Sundry creditors to be reduced by 3,000. This comes to 21,000. General reserve to be retained at old value 36,000. Partners capital accounts. We have calculated the new balances after all the adjustments. These are the new balances of the partners capital accounts. So we'll say X, Y and Z. This will come to 2,01,475, 2,05,475 and 1,03,650. So the total of balance sheet will be 5,67,600, 5,67,600. Your balance sheet will tally. So if you are asked in the examination to prepare the new balance sheet at the revised values, first of all prepare the partners capital accounts, right, which you all know how to prepare the partners capital accounts. To know the partners balances, then prepare the balance sheet at the new values after all the adjustments, right. So this is how we revalue the assets and liabilities. This is the full-fledged practical problem. First of all, prepare the revaluation account, right? Then calculate the sacrifice or the gain by the partners. Then the journal entries, very simple, from revaluation account. Then in case you are asked to prepare the balance sheet, first prepare the partners capital accounts, right, to know the balances, and then prepare the balance sheet, right.